I'm sorry, everybody. I had forgot to hit the recording. So for those that are listening, what we started with is, what is a dividend? And it's just a payback of the company to its shareholders. And the reason people do the dividends is because they just attract, you know, a a certain type of investor. People look for companies that are paying dividends. They have terms such as the dividend aristocrats or the dividend kings that pay, dividends, increasing dividends year after year. And there's some companies that have paid, increased their dividends every year for 30, 40, 50 years, which is kind of crazy, or if you think about it, through all these different, economic cycles. And the question that comes up a lot in terms of the price of, what's the impact of the dividend on the stock price? And like I was saying, if you have a mutual fund and they declare a dividend, they reduce the price of the ETF or mutual fund by the exact amount of the dividend. In stocks, it's a little bit different. And what happens is initially, like if a stock is trading at $100 and it pays a $1 dividend, it will adjust back to $99. But then the market, you know, momentum or is going to make that price go back up or down. So I've seen many cases where the, you know, the stock pays out a dividend and actually opens up. So it doesn't have a direct impact, but generally there's going to be a slight decrease in the stock price after a dividend, but then the market is going to either move the stock up or down depending on if there's more buyers than sellers. And what I wanted to talk about today is just a strategy to kind of maximize capturing dividends. So that's kind of what we wanted to talk about today. So a couple of really key terms in this area. And there's one. It's what is the ex-dividend date? That's the date you need to own the shares in order to collect the dividend. So that's usually, and I'll show you a bunch of different places you could find this information, but the ex-dividend date, that's the date that you need to own the shares. And what happens is if you bought the shares and they're going to take them away, they'll be taken away the day before the ex-dividend or before that day. So that's when I look for ex-dividend trades or dividend capture trades, I'm trying to buy them as close to the ex-dividend date as we can so that if the price moves a bunch, then we still can collect the dividend. So that's kind of the idea. And the declaration date is just the date that the company announces that there's going to be a dividend. And like I said, most of these companies have do dividends every quarter, and they generally go up in amount every quarter. And then the last two things is the date after the ex-dividend date is the announcement date or the I guess it's the record date. And then the last thing is when is it paid out? And generally they're going to be 2 to 4 weeks after the ex-dividend date before the dividend is actually paid. But again, the key date that you really want to focus on is what is the ex-dividend date. So anyway, we'll look at a few places to get that information on where I go. Any questions about either the ex-dividend date, the declaration date, or the payment date? Everybody clear on that? Okay. So before we go into a couple of different websites and the option chain, a couple of key things is if you own the stock before the ex-dividend date, then you are going to get the dividend. If you own the stock and the day that after ex-dividend you get a letter or an email from your broker saying they took your shares away, then somebody took your stock before the ex-dividend date. So that's the key thing. You need to own the shares on the before the ex-dividend date in order to collect the dividend. And the other key thing that a lot of people ask is, do you need to hold the stock for that 2 to 4 weeks? And the answer to that is no. So you could theoretically buy the shares the day before the ex-dividend date, qualify the dip for the dividend, and trade and close it out the next day if you wanted to. But you don't have to hold it until you receive the dividend. And again, we talked about that the stock will often drop by the amount of the dividend, but then the market pressures are going to make it either go up or down, depending on is the market in a bullish trend or bearish trend. And another key thing that I've learned over the years is the size or the percentage of the dividend doesn't represent a value of the stock. So what you'll find is a lot of really poor companies, just terrible companies, um, um, having big dividends. And what I found there is a lot of times those are going to drop a lot by the amount of the dividend. So you just have to be careful in chasing, stocks that have a dividend of 10% or 8%, because what happens is they're doing that to generate, trying to get people to buy their shares. So, and a low dividend percentage doesn't mean it's a weak company, so it just really doesn't have anything to do with that. So that's kind of the really key points. And I just wanted to, before I leave the slides, any questions about any of what I went through on a really high level? Okay, so what I'm going to do is I'm going to stop sharing and I'm going to show you where I go and look for dividends. So here's a couple of, I'm going to go and share again. Okay, so one of the places I like to use is bar chart. And if you go to their free page, you can go here to stocks, and there's a tab here that shows earnings and dividends. So if you click on that, it will go to dividends. So we could look and see what stocks go ex-dividend tomorrow. So today's Tuesday. We missed any of these, but tomorrow, and it will list them out, either the name of the company, or the ETF or the mutual fund. So you can go through this list, and what will show you is, so these are all ex-dividend as of the 24th, the name of the company, what the dividend amount is, what the yield is. Now, this is an annual yield, so it's going to pay 2.7% per year, or 1/4 of that every quarter. It shows you the ex-dividend date, which is 1/24, and then when it's going to be paid out. So it goes ex-dividend on the 24th. The people won't receive their check until February 15th. So that's kind of important information. So another place that you can go to is this is the NASDAQ. And if you just go to dividend calendars, it shows you the ex-dividend date. Here, let's go to tomorrow. The ex-dividend date, the payment date, the date of record, what the payment is. So, and this is the date that they announced it. So if you just go to, Google and do ex-dividend calendar, it will give you a number of different, so I like NASDAQ, I like bar chart, dividend.com. So there's lots of different, websites that will give you the ex-dividend or the dividend calendar. So that's what I use when I'm building the watch list. I look for, what ex-dividend, what stocks go ex-dividend in the next week or two, and then try to screen through them to make sure that they're, stocks that we really want to buy and sell covered calls in. So any questions about where to find the ex-dividend date? One of the reasons I like bar chart, let me just go back to bar chart real quick, is when I go to the stocks, and I go here to the dividends, earnings and dividends, and I will go to Wednesday, for example, and I'll go to, it's like, this is one that is on our watch list for the week. So if I click on this, it will give me a little bit of information about the company. It's rated as a strong buy. I get a copy of the chart. I get to I know what the beta, the PE ratio and things like that. So I like that because I can look ahead to see what stocks are coming up. And then once I pick them, then I can kind of dig in and see if they qualify to go on our list. So that's kind of the way I look for ex-dividend dates. So any questions, and then I'll show you how I look to see how will we get the dividend or not. So before I do that, I just want to make sure to see if anybody has any questions. Okay. So one of the things that I want to do is if we have a dividend coming up, I want to look to see how, what strike do I want to sell? Because that's really key. If you pick the right stock and you are looking for a dividend, if you are, don't pick the right share, then you theoretically could lose out on the dividend. So here I just went to my option chain, and this is a stock that we just saw on the list. It's GBX, and I'm not making any recommendations. I'm just using this one as an example. So over here in the information, it shows I'm gonna qualify. The dividend is 30 cents and it's on January 24th. So that's kind of the key, and it's paying an annualized of 4.29. So that's a pretty juicy dividend. And we've also kind of gone through and said, it's a pretty strong stock fundamentally and technically. So what I would do is go through the option chain, and I'll just open up February 16th. So one of the things that that we would look at, if we were going to sell an out of the money call, say like a 50, which the stock is trading at $46. If we're selling a 50, if you look over here, so that would pay us a credit of 35 cents. So that's an out of the money. And if you look over here to the put side, and you look and say, okay, that on the put side, that's 390. And at the 45 strike, it's 95 cents. So if the amount on the put side is greater than the dividend, then you have a really good likelihood of collecting that dividend. That's probably the easiest way to look. I learned that from Tasty Trade. So if I sold the 40 strike, you see where it has 5 and 10 as the bid ask spread. If I sold this, used the 40 strike, I would not get the dividend. So because there's not enough intrinsic value in that strike. So that extrinsic value, sorry. So if I'm looking at a stock and I'm just saying like, how far can I go in the money to get the dividend? That's the way I look at it. I'll go in and see how far I can go in the money and sell that call and still collect the dividend. And then we run the numbers to say, are we still going to get a 24 annualized rate of return or higher? And are we going to get, an adequate amount of downside protection? So the one I did yesterday, which is kind of struggling today, is Lennar. So it went to ex-dividend today. So I bought the shares yesterday and I sold a 147 call. So the amount of the dividends is 50 cents per share, $50 per 100. So if I was going to do it today, I could go all the way down to 140 because on the put side, it's 55 cents and the dividend is 50. So that's the easiest way that I have for looking at how far in the money you can go. Now, if you wanted to and you just wanted to sell the at the money call, that work, you'll almost always get the dividend if you sell the at the money call. Meaning, if it's at 147 and you sell the 147, you'll collect $3 or $300 plus get the dividend. So that's the other alternative, is to buy the shares, sell the at the money call. But if you want to get the most downside protection, what you have to do is look on the put side and see how far you can go in the money so that you would get the dividend and have maximized your downside protection. So that's kind of the whole strategy in terms of the dividend capture. It's a great way to get a dividend. And if you turn it over in a week or 2 weeks, you can redeploy the capital and get another stock and get another dividend. So that's what I like about the dividend capture strategy. So with that, I'll open it up to anybody who has any comments or questions regarding the dividend capture strategy. Okay, so I guess there's no questions. So I hope this has been helpful. And again, this is one of the strategies that we do in the Alpha Trading club. We do a lot of in the money covered calls. And if we can do an in the money covered call and get a nice dividend, it's an extra bonus. So again, I hope this has been helpful. And if you do have any questions and you want to send me a note, you can message me directly in Eric's group. So thanks a lot for jumping on. I appreciate it, and hope everybody has a great rest of the afternoon and that the market recovery continues. Thanks, everybody.